Hey, welcome back. This is Mr. Market. We're now into episode 26. Thank you so much for joining me. So last week, the Federal Reserve did not raise interest rates, which was pretty much in line with market expectations, but they did leave a little bit of a surprise when they showed that voting members on average expected to raise interest rates 2 more times by the end of the year because the economy is still very strong, labor markets are still really strong, and inflationary pressures, even though they've been coming down, are still a little bit persistent. So what did the market do? It dropped initially on the news, as expected, and then it decided to go rally. It rallied the following day quite strongly. And, this is the part where I'm scratching my head because, in what world is that good news? Where the market wasn't expecting any interest rate hikes, but then all of a sudden there's 2 more possibly on the table. And those 2 hikes could tip this recession from this potential soft landing into a harder landing. And so it doesn't make sense to me why the market would rally. And for me, I just think this market's kind of stupid. So, this reminds me a lot of one of the other times in stock market history when things felt really stupid. You know when that was? That's right. That was the 2000 dot-com bubble. This actually is a lot like the conditions in 1999. Shortly before the market peaked. So let me tell you why. Here's some of the parallels. So back then, I was managing $100 million for a large bank. And so, I was looking at all this research and it was just a crazy, crazy time. We had the economy that was very, very strong, just like that we have today. We've been creating hundreds of thousands of jobs. And because of the strong economy, we had the Federal Reserve trying to step on the brakes to slow things down. So they were raising interest rates significantly, kind of like what we have right now. It was happening back then too. Interest rates were going up, but the market continued to go higher and higher. The thinking was that, hey, we have a strong enough economy. We're not going to be worried about a recession. In fact, higher interest rates means that we have a strong enough economy that there will be good profits for everybody involved. So we have that right now, and the market's shaking off this whole higher interest rate scenario. What else did we have? We had, like today, we have AI, where it has this vast, unlimited, unquantifiable potential. And back then, when the internet was new, all these internet companies were going to the moon because they also had this vast, unquantifiable, unlimited potential. So we have some parallels there. What else? We have an inverted yield curve. That is when short-term interest rates are higher than intermediate to longer term interest rates. And whenever it goes negative, historically, it's had a really good track record of predicting a future recession. And back in the late 90s, we also had an inverted yield curve. So that's another parallel. What else? We have an overbought market. The markets pretty much have just been going straight up since the bottom in October. And we recently hit a pretty significant overbought level for the market. And what else? So something called the equity risk premium. That is also quite low. Equity risk premium is what you get when you take a look at the earnings yield and subtract out from it the interest rates. So it basically shows you the risk reward profile for the market. And if the equity risk premium is low, that means you're not getting a lot of excess potential return for investing in stocks. And when equity risk premium is high, that means you have potentially higher rates of return going forward for taking on the risk of investing in stocks relative to bonds. And right now, that equity risk premium is quite low, which, when you take all these combined, it suggests, it really warrants some caution for the market because it really does feel like the market's partying like 1999. So we have a lot of factors that warrant caution for the market. Do I want to short it? Part of me totally wants to, but am I going to? Heck, no. Now, why? Because look, one of the rules that's really important to remember is that as a rule, we never know how far a trend can go. We just don't. We know that the trend is moving up or we know that the trend is moving down, but as a rule, we don't know how far it's going to go and where it's going to stop. And so like, for example, let's take a look at Tesla. If you use the traditional RSI indicator, the overbought metric kicks in right when it hits 70. And if you shorted Tesla thinking that it was overbought, when it hit that 70 mark on the RSI, well, Tesla was about $200 then. Where is it now? It's trading over $260. So if you would have shorted this right when it got overbought, it got even more overbought, and you'd be killed by now. And on the flip side, the other week we had Target, where that was falling for like 10 days straight. And if you had bought it when it got oversold, you would have gotten killed because it kept going down further and further. So as a reminder, the rule is we don't know how far a trend can go. All we know is that when the trend breaks, we can identify it. So that's really the disciplined approach towards the markets. If you have an overbought or oversold condition, you don't act on it just because it reaches those levels. The time to act on it is after those trends break. Also, one interesting thing about the market is that when it's overbought, historically, the returns actually end up going higher than historical averages. Yeah, I thought this was crazy, but it makes a lot of sense. So there was a study that took a look at the returns for the stock market, and when it hit overbought levels on the RSI, when it hit levels over 70, the historical returns for a stock market actually accelerated from a historical average of 7.5% to 11.4%. And so, this is another reminder that just because the market is overbought, it doesn't mean that the market's going to fall down immediately. Interestingly enough, this study shows that it could be the necessary ingredients for an accelerated move upward. So, it's really important to respect momentum and not fight it. And so, that's the rule. You should not be fighting the trend as long as it's rising. So we have to go wait for it to break before we act. So that's all I've got for lessons this week. Now let's go take a look at how our portfolio did. So for the past week, we were up $252, putting our year-to-date gain to $27,350. And for our inception-to-date return since July of last year, our total gain is $66,298. As a reminder, our goal is to earn $50,000 a year off a $250,000 portfolio, or 20% per year. So we would have been up a lot more last week, but as I was minding my own business, I got randomly struck by this missile that frickin' came out of nowhere and blew up part of my portfolio. Yeah, if you've been paying attention to the news, you'll see that UnitedHealthcare, one of the stocks we had some puts that we sold on, it got trashed the other week because they announced that patients were taking part in more surgeries, and that was going to pressure some of the profits. And before you know it, the stock was at $490, and in the following morning, it opened at $455 and continued to crash to $445. Now, we had some puts that we sold at the support levels at the $460 level, and when it fell below it, I was like, what the frick is going on? And as a rule, I always roll down my strike prices whenever the stock hits my levels. That's just my risk management rule. I do not like it whenever something goes below my levels. It's just one of my rules of discipline, and it has helped me avoid a lot of disasters in the past. And like I mentioned before, whenever you trade, you will experience two types of pain, either the pain of discipline or the pain of regret. And if you use discipline appropriately, you'll be experiencing it quite a lot. And we take these small hits to prevent a much larger hit from happening in your portfolio later on. And those are the people who end up having the pain of regret. And these are the people that hear about the news that blow up their entire portfolio because they did not manage their risks properly. So for us, when UnitedHealthcare came out with that news, thank goodness I had sized my bets properly, because that is what helped me contain part of my losses. Now, when the stock fell below 460 and hit 450, I rolled down my strike prices on my puts, and I brought it down to $450. And then when the price fell even to 445, I gave it a little bit of time to see if it would bounce back, and it did start to stabilize, and it came back to 455. And at that point, it felt like it was stable enough and the time to expiration for these options was short enough that I sold some more puts at the $435 and $440 strike price to overall mitigate the losses by about 75%. But it just goes to show you that even if you have a very stable company, look, UnitedHealthcare is one of the biggest companies in the country. It is one of the components of the Dow Jones Industrial Average, the top 30 stocks in the country. In fact, it is the largest weighting in the Dow. It was also trading in a fairly stable trading range, and it had some decent profitability. But despite all these things, one of the interesting lessons from this is that you could do everything right and you could still lose. And that's just the fact of the stock market. It's just a game of probabilities. And even if you are just minding your own business, pow, you get hit by a meteor that just falls out of the sky. And the most important thing here is that you need to be able to size your bets properly at all times, because there's always this random chance that you can have this obscure risk just blow up part of your portfolio, like we had with UnitedHealthcare. So it's just a case of bad luck, and you need to be okay with this. So size your bets properly, and when disaster strikes, at least in my case, I am always trying to be disciplined and reducing my losses by rolling down my strike prices until I feel like I'm at a safe enough level. Also, it's really important to pay attention to where these support levels are, because if you look at the chart for UnitedHealthcare, there was some good support at $460, and had I waited long enough, had I crossed my fingers and just hoped, the market would have, and it did come back above $460. But I'm not in the business of hope. I'm in the business of managing risk. And when it gets below my strike price, I just take the loss. And again, in order to become a great trader, you need to be a good loser. And that's one of the biggest factors that helped me succeed and helped me turn around my profitability. So yes, this is that pain of discipline situation where I'm taking the loss, but I take that small loss in order to avoid a much larger loss and experiencing the pain of regret. So on to my portfolio. What did I do for this week? So for this week, as you know, I pretty much hate this market. It is overbought. The volatility is really low, so the market's really complacent. And for all these other reasons, that don't seem to make sense, I am just playing it cautiously this week. So I sold some puts on the S&P 500 ETF at the $430 strike price. Plus, I have a little bit of a hedge, so I sold some calls at the $450 strike price that expires on Friday. And then I still have those $450 strike price calls that expire at the end of June for a further hedge. And I don't expect to go make much money this week, but that's the price of just being cautious, and we'll see how it turns out. So that's all I've got for this week. And if you haven't yet, please click like and subscribe. That way you'll know when my next videos drop. Also, you can find me on my new domains, mistermarket.us or mistermarket.us. So thanks again for joining me. Hope you all had a great Father's Day, and good luck to you and your trading for next week. And I will see you next week.